It's inflation versus deflation. What is inflation? What is deflation? Where are we at currently? And what could a transition from inflation to deflation mean for the stock market? Let's start with a couple quick definitions, and you can see here a portrayal of these two environments. Inflation is the increase in the price level for goods and services, and as you might imagine, deflation is the contrary of that. It's a decrease in the price level for goods and services. Today, I want to do a little bit deeper dive of just these two concepts and what they've historically meant for the interest rate market and everything else, but draw some correlations to the stock market. And that's going to be really interesting here at the end of the show, because as you can see at the rightmost part of the CPI chart, the Consumer Price Index, the primary measure for inflation here in the US, we are going from, or at least it looks like we're headed towards, lower inflation and potential deflation. This metric being in positive territory denotes inflation. Being in negative territory, as we were back in 2009, you see earlier on the chart, signified by my nice red circle there, deflation, negative CPI numbers, letting you know that year over year, the prices for goods and services, energy, food, electricity, all these different things is actually getting lower, which might seem like a good thing, but is usually a sign of poor economic times. We'll get into that in a second, but we are right now coming off of the highest inflation that we've seen in the last 20 years. And now it looks like we're almost in a little bit of a free fall. Could this turn into deflation? That's the next question. And what could that deflation mean for stocks, bonds, and everything else? Let's first dive a little bit deeper into where we are now and what it would take to get to deflation, because we still are at 5% inflation. I don't want to get ahead of myself here and say that 5% inflation is not high enough, but we were as high as 9%. And usually you'd think of hyperinflation, which is really historically problematic for economies. That's more in the double-digit realm. When you see 20%, 25% inflation, that's really problematic. But up at 8 and 9%, that was problematic. And that was when we were seeing, gas prices skyrocketing, $7, $8, $9 a gallon gas prices, crude oil well over $100, energy driving a lot of that, and the economic prospering that we saw coming out of the pandemic, the easing that the Fed did, companies really moving forward, taking advantage of that easing, stocks getting to new highs, caused products to rise in price outside of just energy. And we got to, pretty dangerous levels there in summer of 2022. We have trended lower since then, just reported the lowest inflation since going back to more than the last year here. And we've been trending lower consistently. And at this pace, you could see inflation back down to 2 to 3%. And that's considered normal. That's actually the aim for the central bank in the long term, is 2 to 3%, which is, yes, an increase year over year in the price level for goods, but a historical sign of, economic growth at a good rate there. And so that's what they're aiming for. They're getting closer and closer to it. But at this pace, we'll be at 2 to 3% by summer of this year. And if it continues and people are, further incentivized to hold on to their cash and save at the higher interest rates that we're having and not put their money back into goods and services or investments or what have you, we could be on pace for deflation by the end of the year. And that really becomes the question here. And we'll see what that could mean for interest rates right now. And then also draw some correlations to that stock market as well. you're seeing the potential for not necessarily deflation here, but they're definitely seeing projected lower inflation in the short to medium term. And the fact that here we have the projections for where the Fed will put interest rates at the end of 2024, which is a year and a half out, but we're currently at 5%. And the projections here are all huddled around 3%. So thereby projecting a 200 basis point or 2% cut by the start of 2025. And these projections can shift on a dime here. I mean, we start to get some inflationary readings of 2%, 1%. You might see these odds shift even lower, down to 2%, down to 1% interest rates. Traders are definitely perceiving lessening inflation. The question will become if it's to the extent of, I think everyone in the long term sees 3% interest rates as normal, and that would jibe with a, normal inflationary rate of 2 to 3% there as well. They want that real rate around, 0 to 1 or 2% there, which is interest rates minus inflation rates. But this is a slippery slope. And I would be remiss if I didn't point out that the last couple of times that we saw deflation, we've seen stock crashes. Now, of course, this does become a little bit of a chicken egg situation whereby we're bound to see deflation or price levels dropping or people not wanting to spend so much money as a function of fear in the market and stock market crashes. So, of course, one builds on the other. Deflation, I don't think occurs historically and then sends the stock market spiraling lower. But when we see this transition from either a normal inflationary environment or a high inflation environment, like we saw in 2007 and 2008, inflation above 5%, which would be considered high, screaming lower to normal environments of 0 to 2%, 3% there, going all the way into negative territory. That is a little bit off-putting here, especially you look at the right part of this chart where our inflation is and where it's been. It looks very similar to that 2007, 2008 environment where we saw high inflation. Some fear started to pick up. Of course, we've got the regional banking fear that is ever evolving, but has, kind of dissipated a little bit. But a couple of these things pick up and you could see this inflation flip to normal environment, to potential deflation, and the stock market lose, another fair amount. But of course, I have to bring up the fact that these occurrences that I'm pointing out of, 2007, 2008 into 2009. And then, of course, you can look at the pandemic occurrence there as well, where we saw just a touch of deflation for really 1 or 2 data points in the coinciding stock market crash, but then bounce back right after the fact. This is literally the definition of small sample size. This is 3 examples in the last 20 years of data here. And we saw, in that 2015, 2016 era, some touches of deflation. And there was definitely some stock market turbulence at that time. That was not, a year or two of just chugging along to new highs per usual. But small sample size, I can't hang too much on these data points. But the historical correlation is there. I also want to leave off with this. If inflation can get back into that 2 to 3% range here, I'm just highlighting the occurrences of 2 to 5% to get more. Then you see there in that black line, the stock market, that's when we saw all-time highs in stocks just chugging along per usual. That period between 2003 to 07, that period between 2010 to 2015, and then of course more recently, right before the pandemic, and then the couple of years coming out of the pandemic until now, when inflation got high, saw middling inflation and some of the best stock market performance that we've seen. So if the Fed can land the plane, so to speak, get us to an inflationary environment that isn't dropping from 9% to 5% down to sub-0% inflation, this could correlate to a great comeback in the stock market. But there you have it, the difference between inflation and deflation right now, rapidly transitioning from inflation to hopefully just normal inflationary environments of 2 to 5% here. But it does look eerily like that occurrence there in 07 and 08, where we went from high inflation to deflation. We'll see what happens in the future, my friends.